Welcome to the 6th video of our Price Action Roadmap series. In previous videos, we've covered a lot of important topics, and you can find the links to those in the description below. Today, we'll continue on this roadmap by diving into several key candlestick patterns under basic price action. These include the piercing line, dark cloud cover, 3 inside up, 3 inside down, 3 outside up, 3 outside down. Let's start by understanding the piercing line pattern. The piercing line pattern consists of 2 candles. The first is a red bearish candle, followed by a green bullish candle. This pattern signals a possible bullish reversal in the market. Imagine the market has been in a downtrend. Sellers form a strong red candle that closes near the support area. The next candle opens below the red candle's close, but buyers step in at lower levels, pushing the price up. The green candle closes above the halfway point of the red candle, indicating that buyers are gaining control. After a series of red candles, a strong red candle forms near a support level. The next candle opens lower but closes higher than 50% of the previous red candle. This is your signal to prepare for a bullish reversal. Once the green candle closes above 50% of the red candle, you can enter a long trade with a stop loss just below the support level. Dark cloud cover pattern. The dark cloud cover pattern is the opposite of the piercing line. It consists of a green bullish candle followed by a red bearish candle and signals a potential bearish reversal. In an uptrend, buyers push the price up, forming a strong green candle near a resistance level. The next candle opens higher but is pushed down by sellers, closing below the midpoint of the green candle. You spot a green candle that forms near resistance. The next candle opens higher but closes below 50% of the green candle's body, creating a dark cloud cover. This pattern suggests that sellers are starting to take control. You can enter a short trade once the red candle closes below 50% of the green candle. Place your stop loss just above the resistance area to protect your trade. Let's understand the 3 inside up pattern. The 3 inside up pattern consists of 3 candles, 1 bearish red candle followed by 2 bullish green candles. This pattern signals a potential bullish reversal. A red candle forms during a downtrend near a support level, but it doesn't break the support. The next candle forms a small green candle inside the body of the red candle. The third candle is a strong green candle that closes above the red candle, confirming the bullish reversal. You notice a strong red candle near support, followed by a smaller green candle. The third candle closes higher, confirming the 3 inside up pattern and signaling a bullish reversal. After the third green candle closes, you can enter a long trade with a stop loss just below the support area. 3 inside down pattern. The 3 inside down pattern is the opposite of the 3 inside up and consists of a green bullish candle followed by 2 bearish red candles, signaling a bearish reversal. A green candle forms during an uptrend near a resistance area. The next candle forms a small red candle inside the green candle's body. The third candle closes below the green candle, confirming the bearish reversal. After a strong uptrend, you see a large green candle near resistance. The next candle is a small red candle, and the third candle closes below the green candle, confirming the 3 inside down. You can enter a short trade after the third candle confirms the reversal. Place your stop loss just above the resistance level. Let's understand the 3 outside up pattern. The 3 outside up pattern consists of a red bearish candle, followed by 2 green bullish candles. It indicates a possible bullish reversal. In a downtrend, a red candle forms near support. The second candle is a strong green candle that closes above the red candle's body. The third candle is another green candle that confirms the reversal. You spot a red candle near support, followed by a strong green candle that closes above the red candle. The third green candle forms, confirming the 3 outside up pattern. Once the third green candle closes, you can enter a long trade. Place your stop loss below the support area to manage risk. 3 outside down pattern. The 3 outside down pattern is the reverse of the 3 outside up. It consists of a green bullish candle followed by 2 red bearish candles, signaling a bearish reversal. During an uptrend, a green candle forms near resistance. The second candle is a strong red candle that closes below the green candle's body. The third candle confirms the reversal by closing below the red candle. You see a strong green candle near resistance. The next candle is a red one that closes below the green candle, followed by another red candle confirming the 3 outside down pattern. You can enter a short trade after the third red candle confirms the reversal. Place your stop loss above the resistance area to protect your trade. So today, we've covered the piercing line, dark cloud cover, 3 inside up, 3 inside down, 3 outside up, 3 outside down, candlestick patterns. Next week's video will be our last in the price action roadmap series, where we'll cover all the remaining topics and get ready to jump into chart patterns. I hope you're finding this series helpful. Make sure to go back and practice these powerful candlestick patterns on real charts. Testing them out in live market conditions will really help solidify why. Thank you all for your incredible support. If you haven't subscribed yet, please hit that subscribe button. It really helps the channel grow. I'm Trader D, and I'll see you in the next one.